Thank you everybody for giving up half an hour of your lunch break today to spend some time with us. We've got Alan King from CNS Partners, accountant from CNS Partners. I'm Jack Gallagher from Notch Above Bookkeeping. We're Xero certified advisors and bookkeepers based in Alderley. Alan's from CNS Partners, also based in Alderley. And I just thought it would be great to get Alan along today to tell us a little bit about self-managed super funds and how that can help you. Just sort of an overview and an introduction to how self-managed super works. And from that, then you'll get an indication as to whether that strategy may be for you or not. Just some housekeeping. If you've got questions, etc., just type them into the chat window and we'll get to those probably near the end of the webinar. And other than that, enjoy, and I hope it's of use. Over to you, Alan.
Great, thanks, Jack. Good afternoon, everyone. Thank you for taking the time to listen in. Thanks to Jack and the team at Notch Above, also for providing the opportunity to talk to you about something I'm very passionate about, which is taking control of your retirement. My objective today is just to provide a broad introductory overview about self-managed super funds. So we'll call it SMSF 101 if you like. So possibly I'll be covering some ground that some of you are familiar with, and if that's the case, I apologise in advance, but I'll deliberately try not to get too technical. So if anyone has any questions of a more specific nature, happy to answer them later on, or you can contact me directly. So I just wanted to give you a broad overview of where we stand. Starting with a bit of a history lesson, a bit of background. Compulsory super was introduced by the Keating government in the early 1990s and has grown today to be the largest sector of funds invested in the country. So what that means is that there's more money tied up in super than in any other form of investment domestically. With that size obviously comes power, ambition, and much lobbying and interference from those with vested interests in a particular direction. Traditionally, governments have not done a good job of selling super as a concept, and most people do not think much about it until they are near retirement age, which is too late. Generally, we allow our employer to choose a fund for us, and we assume that the employer is putting money in there regularly on our behalf, and we get an annual statement each September or October that we may not even read or, for that matter, understand. However, when you consider that super is potentially the single biggest investment we will have, apart from the family home, or even in some cases it'll be worth more than the family home, we really should be making an effort to look after it and make it work as hard as possible. Relying on the age pension is not as guaranteed as it used to be, and even then, we have to ask ourselves, will it be enough to provide a comfortable retirement lifestyle? So if we look at these couple of graphs we've got up here for a minute, the first one showing that prior to the 90s, there were only a few people that actually had access to super, generally government employees, whereas we bring it forward to the current day, pretty much everyone's getting super from their employer. And if we look at the amount of money we're talking about, it's risen from its early days to be a significant chunk. And we're really seeing that the bargaining power, the purchasing power, the voice that super has been given by having this much money, to the point now that it's a huge political football. One thing that governments do well, however, is meddle and interfere, unfortunately, and me being cynical, generally for the purposes of their own re-election rather than for the long-term benefits of the constituents. We've experienced much change to the rules in the last decade, right up to the current skirmish around the increase of compulsory employer contributions. There's also a massive campaign of self-interest and misinformation being conducted by players from all sides regarding retail funds, industry funds and self-managed super funds, which is hardly surprising given the billions of dollars at stake, but all the more reason for everyone to gain a better understanding of where they stand and to ensure that they are engaged with the process and confident that the best possible care is being taken with their super savings. Current statistics indicate that the average balance of 60 to 65-year-olds is approximately $100,000. Much debate rages in the media about how much is enough, but a common number thrown around is about 350,000. Regardless of how accurate the estimates are, what this shows us is that there's a huge difference between where we are and where we need to be. And if you're needing 350 and you've only got 100, then you've got some issues to ask about how comfortable your retirement is going to be. If we look at a few of these statistics, we've got enormous amounts of money. So $90 billion contributed in one financial year, $50 billion paid out in benefits. Total assets inside super at the end of December last year was $1.8 trillion. Now, obviously, it's time to look at this sort of statistics. We'll get off my soapbox and we'll talk about the largest slice of the pie, which is self-managed super funds, or DIY super, also known as. So roughly 1/3 of all of that money we've just talked about, the $1.8 trillion, is held inside self-managed super, and this is growing rapidly. So if you look at the stats in front of you there in the bottom right corner, as of March 14, we cracked 1 million members of self-managed super funds. So there's approximately 530,000 funds with 1 million members in them at last count, and this is steadily growing. So you'll find that every time you open a newspaper, go to a barbecue or have a game of golf with someone, there's a conversation about self-managed super. To some degree, it's become a bit of a status symbol, a way of keeping up with the Joneses, if you like. While I strongly believe in the concept of DIY, it's really important to realise that it's not a magic elixir and it doesn't suit every person. The issue of cost is often brought up, and we'll look at that in a minute, but there are other issues to consider as well. Trustees have responsibilities and obligations and a level of involvement that not all want to assume, and plus investment decisions need to be made, which is the whole point of do it yourself or self-managed. But this adds a level of responsibility and commitment that is not suited to everyone. So before you set up your own fund, you need to understand what's involved. Every member must be a trustee, and every trustee must be a member. There are exceptions to that rule, like the English language, but as a holistic approach, we'll leave it at that. You can only have a maximum of 4 members, and members need to be connected in some way. So most common is a family. For instance, you have a husband and a wife going together in the fund. The funds must have financial accounts prepared each year, have a tax return done, and they must be audited. Under new rules just set out by the ATO, penalties can be levied for breaches of the rules and regulations. So really important to understand what's involved and what your obligations are. The process of setting up, we will always recommend to use a company, and this is a lengthy debate that we can have. Simplistically speaking, it gives you flexibility and added asset protection, as well as a greater level of protection from ATO penalties. So when there's a choice between using individual trustees or a company, we'll always recommend a company, even though there's a bit of extra cost in setting it up. So roughly speaking, the cost to set up a company and a fund to get the deed done up, you're looking at about $1,500 upfront cost. Next step then would be to apply for an ABN and a tax file number, and depending on what assets you've bought, there might be a need to have GST registration, which creates other complexities such as having to do quarterly bases and may increase your compliance cost a little bit. Really important to know the rules and have someone good on board, because there are unique issues with GST relating to super funds that aren't applying to other entities. Next, you need to set up a bank account, then looking at rolling your funds over from your other super accounts, so your industry super fund or your retail super fund. And it's important to look at your insurance coverage inside your other funds and make a decision whether it might be worth leaving a few dollars in your existing fund to cover that, so that you've got ongoing insurance coverage inside that fund. And there again, you need to get good advice. So let's stop for a minute and look at the costs. This is a piece of information I came across from an industry super fund. Not wanting to pick on BusQ in particular, but this is something that I came across where they're sprouting some numbers which I think are horribly inaccurate. If you look at what they're talking about with self-managed fees, they're talking about somewhere between $3,500 and $5,000 to administer your fund. What I think is more pertinent is to look at the next column, which shows you their fees, which could be as high as $16,000 a year for a balance of $2 million. The reason this is that they're charging you a percentage of what they call funds under management. So the more money you've got in there, the more it's going to cost you. Generally, an industry fund will charge you about 0.8%, a retail fund up to 2%, which really can add up quite quickly. So the common amount discussed by ASIC and other media players would be that you generally need $200,000 to set up a self-managed super fund to make it worthwhile. So if you're looking at the percentages I've quoted you before, $200,000 in an industry fund would cost you about $1,600 a year. In a retail fund, it would cost you about $4,000 a year. So if you're looking at the slide in front of you there, I estimate that it would cost you about $2,000 to run a self-managed super fund a year. Now, obviously, the more money you have in super, the better the super fund looks, self-managed looks from a cost perspective, because the fees aren't based on a percentage of funds under management or your member balance. So if you're looking at cost alone, it's easy to see why people are throwing around the number of 200,000, or some of them are going up to even 500,000. But I don't think the argument is as simplistic as just cost. You've got to look at whether it's right for you, and there are other factors as well. For instance, when you consider that you're paying your current fund not only to look after your money, but also to make the investment decisions for you, if you wanted your own fund to make decisions and you wanted some help because you weren't confident, we'll throw in the variable of paying for someone to give us investment advice as well. So assuming that you're paying for a fee for service and not a percentage of member balance, you could pay, say, $3,000 to $5,000 a year, which when you're looking at it as a purely a cost comparison compared to the cost of an industry fund, it's probably pushing you towards break even at more than $1 million rather than your $200,000 or $300,000. So what we need to look at then is, okay, what else factors into the equation other than just the cost? So for me, there's two other issues. Firstly, you may believe that you can do a better job, that you can produce better returns than the big funds. And secondly, you may want to invest in assets that a big fund can't get access to. So if we look at performance, and is it just as simple as saying, oh, one genius will pick better stocks than the next person? I don't believe that tells the whole story. And this is one of the big differences between self-managed and the larger funds. The demographics of a large fund mean that they are catering for ages from 18 up to 75 plus. And all of those people have different time frames and different appetites for risk. So what this means is that the investment decisions of the fund are modified to cater for all rather than focusing on one specific group. Clearly, a 20-year-old has a different time frame and therefore would want to make different investment choices than, say, a 60-year-old. Yes, it could be argued that big funds offer different choices, for instance, balance, growth, etc., but they are still limited by having to please a broad spectrum of people. Now, if you look at this slide up in front of you, I've included some stats from an industry fund, which I'm not going to name because I don't want to get accused of picking on anyone, but to me it highlights a valid point. Over a 10-year period, if you look at the column on the right-hand side, the returns from their different options really don't differ a great deal at all. The only thing differing in those different options is how much you pay for them to manage it. And to me, that's because they've had to cater for a majority. They've had to cater to the masses. So the clear advantage in the self-managed fund is the ability to focus on the 1, 2, 3 or 4 members who are generally at the same stage in life. So, for instance, a couple in their early 30s, they can focus on growth assets knowing they have 30 years before they can access their money. A couple in their 60s can move their weighting more towards income and take advantage of tax credits to suit their stage in life. Attitude to risk is also a factor. Some people like to be more aggressive and take bigger risks. Others are more conservative in nature. So controlling your own fund allows you to plot your own path, which then flows us on to the next point, which is choice of assets. SMSFs can invest in shares, managed funds, direct property and collectibles. But I don't want to talk too much about collectibles. They're a lot more difficult these days because the rules have been changed by the ATO, and I don't really advocate them as a good investment anyway for a variety of reasons. The big appeal that's making a lot of noise in the media at the moment is direct property, and this is made even more attractive by the ability to borrow money because those concessions came in only a few years ago. So property can include residential or commercial. And commercial property offers the opportunity for business owners to purchase premises to run their businesses from. As a general rule, super fund members aren't allowed to gain any benefit from the fund's assets prior to retirement. But the big exception is the ability for a related party to occupy business premises. So in practice, this means that a mechanic who operates his workshop through a company, trust, or even as a sole trader could buy the premises in the self-managed super fund and rent it to the business entity. As with anything, it's important to understand the rules and regulations, and it's really important to get good professional advice before making any decisions, particularly when your borrowing is used to fund the property purchase. Even when purchasing straightforward assets, such as direct shares, self-managed funds have always provided greater control and flexibility to make specific choices. Many of the public funds are now trying to combat the growing dominance of self-managed by offering the ability for members to buy direct shares. However, the choices are narrow, for example, limited to the ASX Top 300. This highlights the ongoing battle for a share of the super pie, and if the larger funds have their way, they will compete to remove many of the differences that have made self-managed attractive in the past. Even though I'm an advocate of self-managed, I don't really have a problem with that, because if any improvement that is made between this fight for attention benefits the Australian people, then that's a good thing, and it provides greater hope for a better retirement lifestyle. In my opinion, there will always be aspects of the self-managed fund that will allow more options because of their small membership, which allows nimbleness of decision-making. What it reinforces to me overall, though, is that everybody with a super account needs to understand what their options are and what the pros and cons of each choice entail. So the options inside self-managed super include making all your own decisions, paying an advisor to make all the investment decisions, or a hybrid of these two. Keeping in mind, obviously, that bringing in a third-party advisor will add to the cost. So I just wanted to talk to you about responsibilities, and this is another key thing, because some people just say, well, it's all too hard. Other people say, look, if I do everything right and get some good advice, it's not going to be an issue. So as each member is also a trustee, they bear full responsibility for all decisions made. Unfortunately, ignorance is not a defence when things go wrong. So I just wanted to give you a scenario here. Let's say we've got a husband and wife. The wife doesn't really want to know about it. The husband likes to get involved and he's interested in it. So the wife says, all right, you do it all. I'll trust you. Excuse me. I'll trust you to make good choices. The husband goes off and invests in some incredibly speculative mining company, loses the entire balance of the funds. So basically, they've lost their life savings. The ATO then comes looking for unpaid tax. And the wife's defence is, look, I didn't know anything about it. It's not my fault. I can't help you. The ATO still notifies that they'll be chasing her personally, and her defence again will be, look, the husband defrauded her. This is an extreme example, but let's throw it out there. This leads to a marriage breakdown. As part of the divorce proceedings, the wife says she wants compensation for all the super that's been lost by the husband's negligence. The end result would be, both from a family court point of view and from the ATO, that she should have known what was going on and was actually a willing participant, with the end result being that she's lost all of her super and is also obliged to finalise the ATO debt as well. So with any of these scenarios, whether created or based on case law, it would be easy to say, oh, but that would never apply to me. Unfortunately, from personal experience, the chance of someone falling foul of the rules is very high, and it's vital to understand what can and cannot be done. A common example I see on a daily basis is people experiencing cash flow difficulties in either their business or their personal budget. They look at the money sitting in the super fund bank account and they say, oh, I'll just make a short-term loan. After all, it's my money. The potential penalties can be huge, and because your fund is audited every year, be sure that your sins will find you out. So it's really important to know the rules. I'm not trying to scare people into what not to do. It's just a case of being understanding of exactly where you're at. It's very possible to run a clean fund without any complications and never experience any compliance issues at all. What I would like to emphasise is that if you're going to do this, you need to understand exactly what your obligations are as a trustee, and the importance of getting good support and advice from your accountants or lawyer or financial advisor or all three to ensure ongoing compliance. Again, I come back to the suitability of individuals to be members of a self-managed super fund. So it's not just about cost effectiveness. It's not about how much money you've got in there. It's about whether you're suited from a personality point of view to going through this process. If being a trustee and making investment decisions seems like too much hard work, perhaps you're not suited to controlling your own destiny, and you'd be better off letting others do the work for you, for instance, leaving your money in a public fund. And there's plenty of public funds doing a good job. There's plenty of people using self-managed that are doing a good job. It's really a case of individual circumstances and what's going to work best for you. So other issues that we should be looking at briefly would include insurance, pensions and estate planning. Now, all of these issues are not unique to self-managed. Any fund can deal with these, but there are differences in the process and also the outcome between funds. If we look at insurance first up, public funds will always argue that they can use the bulk buying power of their large membership base to provide cheap insurance premiums. There certainly is truth to that argument, and sometimes a self-managed owner will leave money in their public fund and leave the account open to continue to get the benefit of that insurance cover. However, it's really important to read the fine print and understand exactly what is covered, what circumstances would enable a claim to be made, and how much the cover is and how it will change over time. For instance, some funds issue insurance cover in units, which decrease in value every year you get older, which may or may not suit your individual set of circumstances. Also, if the public fund offering is insufficient or you want more outside of that, insurance can be purchased through the self-managed fund. The fund will be the owner and the life insured will be the individual member. Most commonly, life and TPD or temporary and permanent disability insurance would be what's purchased because it's tax deductible within certain guidelines inside the fund, and owning it outside of super will not entitle the owner to a tax deduction. Most members are also attracted to this because of the tax benefits, but the cash flow is a key. So you can use the money inside super instead of using your own hard-earned funds, which are probably overstretched already. Again, good advice is important because there may be good reasons not to hold life insurance inside super. The rules have also changed recently about what you can hold inside super, so I reiterate the need to be correctly informed. Income protection insurance can also be held inside super, but I question the value of doing so in most circumstances, particularly when you can get a tax deduction outside of super to an individual. Pensions, as I said, you can get a pension in any fund, but in order to draw a pension from superannuation, a condition of release must be met, such as turning 55, which is currently gradually moving towards 60, or the other point one is retiring. There are other conditions, but these are the most common. The self-managed fund can be converted into pension mode and then can run both accumulation accounts and pension accounts, which is where the flexibility value kicks in over the top of your large public offer fund. Changing a fund into pension mode means that the earnings can be tax-free and refunds can be gained from franking credits. Public funds obviously also do this, but again, the advantage of the self-managed is the flexibility. Public funds will generally convert all of your member balance in cash mode, and it'll be getting the investment return equivalent to being in cash mode, so reducing your earning capacity. Whereas members of a self-managed fund can still choose what investments they're in and therefore can potentially chase greater returns. Public funds also will rarely allow members to run more than one pension. While the strategy is easy to achieve in self-managed and can be very rewarding, you can stop and start, and during the year you can run multiple pensions, and you've got that ability to be a little bit more proactive with how you look at things. We'll look at a topic that no one really wants to talk about, but unfortunately we don't do enough planning for, and that's for the time when we're no longer here, which, bluntly speaking, is inevitable. We'll all go one day, and we need to think about what will happen to any funds left when we're gone. I mean, some of us would love to think we'll spend every cent and not worry about leaving anything for the kids, but those that do want to need to make sure that it's a trouble-free process and that there's not endless fighting when they're gone. So members can choose death nominations, which are either binding or non-binding, and each of these can have significant implications. Public funds will generally put a 3-year expiry date on a binding nomination, and so they'll require you that every 3 years you'll have to redraw it, whereas a self-managed fund can offer a non-lapsing version. which stays in place until someone deliberately makes an effort to change it. Issues can arise from non-binding nominations, which is essentially a statement of wishes. So you tell the trustee, this is what I'd like to happen, but the trustee still has the final discretion to make whatever choice they want based on the information they have at hand. And this can cause problems. In a self-managed fund, generally the surviving member and trustee is a spouse, and you'd like to think you can rely on them to carry out the wishes of the deceased member, especially as the spouse is usually the beneficiary of the member's money. However, the public fund trustee doesn't know the personal circumstances, and they can be swayed by other factors. For instance, children or previous partners, previous children from other marriages and things like that could potentially get in on the act, which just creates drama for everyone. The last thing I wanted to look at was the argument that Big Super used to use. The public funds used to say, oh, we get real-time access to your information, you can log on to the internet anytime, and you can have a look at what's going and how we're growing your money. So that used to be trumpeted as a significant advantage that the big funds had over self-managed. Traditionally, self-managed funds, at the end of the year, you'd get your gear together and you'd send it off to your accountant to do the work, and it could be up to 9 months after the end of the financial year before you have your information. I've never really seen a problem with that myself, because generally a trustee of a self-managed fund will have access to the fund's bank account and also, say, their online internet broking account. So they'll be able to look at those things and get a fair idea of how they're going anyway. But the big change recently now is that software developers have jumped on board, and so they're producing programs which allow the funds to be administered in real time. They get updated daily, and they've got live asset values. The beauty of this is that the administrator of the fund is able to grant access to the members and trustees so that everyone can have a look and see how it's going. So the big advantage that used to be trumpeted by the big funds has now largely been eliminated by that. So we're getting close to the end of our time. I hope I haven't bored you or gone over too much old ground, but if you just want to look at some key issues to take away from today, you really need to consider the costs to establish and maintain the fund. You need to understand your responsibilities as a trustee and a member, what you can and can't do. Ask yourself the question, can I or my chosen advisors do better, produce better results than the big funds that have already got my money? And, do I want to be in control of my own destiny? Do I want to make those decisions and be hands-on? Really important that you get good advice and that you get involved. Roll your sleeves up, be engaged, get actively involved in the process, and really understand super as a valuable part of your retirement strategy. And on that note, plan ahead. Look at, when do I want to retire? How much money do I need to retire? And how am I going to go get about it? And it's not about just paying off the home or the rental property or buying a few shares in your own name. You've got to look at the value of super as part of that strategy and really consider its value as a piece of the puzzle. If you want to look at the ATO, they've got some really good information there. They've produced some little videos, and they've also got some great publications. Their favourite saying is, it's your super, but not yet, which I think sums up the attitude to it, that you've got to be a little bit careful about what you're doing.
Great. Sorry, Alan.
Yeah, no, that's it. That's all I was going to say. Over to you, Jack. If anyone's got any questions, we'll go through them now.
Great. Thanks, Alan. Thanks for that information. Now, we'll put up those links on my website, so you can follow those through later and have a read of that if anyone listening is wanting to look at those. There's a couple of questions here coming through. Just a question here from Ruth. What about the pension timing? You talked about that being available at the pension phase at 55 now, and that gradually increasing out to 60. Is it going to be a point that you're not going to be able to get funds out of super until 60 in the near future, or what's the timing on that?
It depends on your date of birth, unfortunately, so it's not an easy question to ask answer without asking personal questions. But initially it was 55, gradually going through to a point where everyone will have to be 60. So it depends on the year you were born as to when you can access the funds, but there will be a time where no one's going to be able to access their money prior to 60. And it's very important to realise that if you think, all right, my strategy is to chuck heaps of money into super so I can retire early at 50. The problem is that between 50 and 60, you won't be able to access your super. Therefore, it's going to make your early retirement strategy challenging if you haven't developed assets outside of super. So there's a few things to consider there.
Right, and I guess that's where the whole investment strategy comes in, and you're able to help with that, are you, as far as planning for what needs to be in and outside of super?
That's right. You need to understand all the options and the potential, and that's why it's really important to start early and to think it through and have a clear plan in place as to how you want to attack it. I mean, we don't know. The government's changed the rules all the time. They love to have a fiddle. The pension age is already being progressed out to 70. People are saying, oh, we should make the access to super push out to 65. That hasn't happened, and I'm hoping it won't, but you just don't know what governments are going to do in the future. So you need to be aware.
Okay, great. Another question here from David. Now, the process of getting a self-managed super fund set up and rolling all your super into it, is that complicated, or can we just go, Alan, please do all this for us? How does that work?
It's not complicated. To set up the actual entity takes about 24 hours. To apply for an ABN tax fund number, very straightforward. Generally, the fund that you're with will have a form that you can fill in. The hard part there is some funds don't like letting go of your money. So sometimes it takes a few weeks. If you're rolling from one public fund to another, they'll do it by EFT within a certain government-mandated time frame. If you're doing it to a self-managed fund, they'll generally say, oh, we'll send you a cheque. And that could take a couple of weeks to send you the cheque, and then you've got to go and bank it and wait for the cheque to clear. So the time-consuming part is getting your money off the other fund. And some funds do it better than others. But generally, the process doesn't have to be that much of a drama.
Right, I hope that answers your question there, David. Okay, any more questions? I think that's all we've got for today. So I'll put up on the Notch Above website all Alan's contact details and those slides, if that's all right, Alan, as well. So people can contact you if they've got any further questions. Thank you very much for attending today. I appreciate you.